Hey everybody, welcome back to the channel. I'm Dr. Johnny Walker, aka Jonathan with Adachi. On this channel, we empower dentists and really any business owning professionals that are looking to achieve financial freedom through the world of passive investment in real estate and alternative investments. Well, today's topic, we're going to talk about, I just said alternative investments, right? So we're going to talk about conventional investing versus alternative investing on today's channel. So first thing we'll do is define what each of those are. Most of you are probably familiar with the conventional side, but we're going to talk a little bit about that. Then we're going to talk about the pros and cons, as well as the historical returns and what you should do and which one should you invest in. And hopefully this video will answer some of those questions. Joining me in presenting this video is an expert in the world of alternative investing and real estate. He's a fund manager and as well as a good friend of mine, my friend, Mr. Sam Silverman. So let's bring in Mr. Sam Silverman.
Hey, Johnny, thanks for having me on here.
All right, guys, settle down. Sam, thank you so much for being here. Let's start off, man. I mean, let's let you introduce yourself a little bit. And then we'll get right into today's topic.
So kind of my background, I came up through the world of tech, where I ran large sales teams in the tech space and got into the alternative investing space by, buying single family houses. Longer term, kind of realized that was just too much work for me with my W-2 job. So kind of transitioned out of all those homes, started investing passively as a partner into primarily real estate deals, and I've kind of transitioned route to being a general partner, fund manager over a variety of alternative investments between real estate, debt, and some private equity too, which I'm sure we'll cover here as well.
All right, sweet, very good. All right, well, let's get right into today's topic here. So first thing we're going to do, we're going to define this, right? So let's start with conventional investing. Now, typically this refers to the traditional, widely known investment vehicles, such as, give me some of the, most common conventional investments here, Sam.
Yes, when you're looking at, stocks, bonds, mutual funds, ETFs, I think you're even seeing REITs kind of go down a route of being more conventional as well in terms of what people have access to. On my end, actually probably one of the few people I'll talk to, I don't think I own a single share of a public company anymore. I used to be really heavily levered in that I worked for a public company when I was in tech and just had way too much of my compensation tied to a single company. So probably far on the other end of the spectrum where I have nothing in that market at all.
Yeah, that's same with me. I don't have any shares of stock. So what exactly is a stock? I mean, when somebody's buying a stock, what are they buying?
Yes, when you're going through and you're just buying a share in a public company, right? In terms of one piece of a share, a fraction of a share, multiple shares in a publicly traded company, you can get to the value at what it trades at every second, which I think is interesting. They're liquid, which I think is really appealing too when looking at that market. But again, you're really tied to the market swings and volatility, as we said as well.
And then, some of the other ones like bonds. I mean, what I hear about bonds. I mean, what is a bond? When somebody invests in a bond, what are you doing there in a bond?
Yes, you're lending money to companies, the government, for fixed income type returns. I don't personally have a ton of experience in that sector, but I'd say you look at the risk, you're looking at a much lower risk profile than, the public equities market or the private equities market as well.
Yeah, I mean, until recently, though, bonds were falling through the floor over the last over the last couple of years, right? After bonds were thought that was the safest investment that you can kind of go into. Now, what about mutual funds? What is a mutual fund?
Yeah, so you're really pulling capital together to invest in stocks, bonds, other types of securities. I think when you look at this year, you typically see pretty high fee structures in terms of how they're managed.
Yeah, so it's not, and then ETFs, the exchange traded funds. What exactly is that?
Yeah, so basically just a kind of bucket of securities that are put into, kind of one group that trades more to a stock, right? So they can be bunched up in certain ways, as well.
These stocks, bonds, mutual funds, they're all, sort of market related. These are your traditional investments that probably most of us just by default as dentists are kind of just pushed towards, right? So, Sam mentioned he started out with having stocks. and now he doesn't. I mean, I personally also was the same route. Once I learned this world of alternative investing, I now no longer have any stocks either. We're going to talk about some of the pros and cons and probably why we have chosen to go kind of against the grain of convention. And now, so let's talk a little bit about the pros of conventional investing, right? Like some of the advantages. So there's pros and cons to any investment. There's no such thing as a perfect investment, in my opinion. It really comes down to what your goals are, what you're trying to achieve in the long run, your risk tolerance, etc. But and even if we don't personally invest in it, a lot of people do invest in these things, right? The stock market and bonds is multi-trillion-dollar holdings, right? And some of the advantages. What are some of the advantages of stocks, right? Like what would you say? What is the biggest advantage of stocks versus
I think
real estate or such as that?
I think one of the biggest things is just the liquidity it provides you, right? In terms of being able to go in and sell your offering whenever you choose to, right? There's a huge secondaries market always. There's a huge publicly traded market where you can go in and exchange product. There's always a buy and sell on them. So I think that's a really big thing in terms of keeping your liquidity, right? Something that, we notice, especially in the alternative space, is the lack of liquidity, right? There's a trade-off. And I think one of the big trades you have is the access to your capital. I think when looking at your, stock portfolio too, the ability to go leverage against it. So for example, you want to go take out lines of credit or loans against the portfolio balance due to the liquidity that you have. You can also go lever up, right? Looking at options, you can go, get, more leverage against the positions that you're taking as well. Get, bigger multiples, whether positive or negative, depending on how you do. So I think the biggest thing that it ties to is the liquidity, regulation in terms of fraud, as well. And, I think really consistent returns over time as well when looking at kind of the stock market as a whole. I think to me, if you're going that route and, don't take my advice as someone who hasn't gone that route, right? But I'd say if you're going that route, kind of sticking with it the long term makes a lot of sense in terms of the capital you have in there, the standpoint that, everyone's seen those charts where if you miss a few certain days in the stock market, your return profiles look very, very, very different in terms of those big pop type days. So what I'd say is if you plan on having capital in there, keeping it there is super important. For parts of your money, I think is definitely kind of how I look at it.
Yeah, I mean, even if we don't personally, care for the stock market so much, if you look at the asset allocation of some of the wealthiest individuals, they still have holdings in equities, right? But I have a strong feeling that they have a much more concentrated approach to stocks, and I don't think that a lot of billionaires are holding ETFs. That's just my guess, right? Like, I mean, this is a way, I guess, to conserve wealth. And your point about liquidity, I mean, that's probably the biggest con for me too with these real estate, especially these syndications, these type of investments, is that there's no liquidity. There's no secondary market. There's no way to, I mean, like, some people are trying to have a secondary market with these type of investments, but there's no way to really sell these investments, and you're stuck for a time period. Whereas the stock market, I could be talking to Sam right now, and I could be selling stock on my phone at the same time. So that part of it is kind of attractive, right? The liquidity and the ability to get money when you need to, albeit heavily taxed. Also, you're cutting your net worth when you're taking out the money, but the liquidity is there if you're selling stock. You mentioned regulation. A lot of people might think regulation's a con, right? But kind of go into that a little bit. Why is regulation a pro? Why did you consider that a pro of the of stocks?
Yeah, I think when you look at regulation there, it helps for things like fraud, right? In terms of having, a board, right, and a federal regulatory agency that goes in and reviews transactions, right, reviews annual reports, quarterly reports, big actions that are taken by companies. I think it's helpful to go have that where you can feel confident when you're putting your capital in certain places that there's that kind of overarching arm that, helps make sure things are going the most fair way possible. I think when you look at the alternative side of that too, there's, regulation can only do so much in certain areas. And what I mean by that too is that a lot of stuff, when you look at the stock market, you can see huge swings in values of companies based on something a CEO says or a news article, right? Where you have these huge swings based on how the market can be manipulated or moved in a certain way. So I think the regulatory board is trying to do a good job of it, but there's always things that happen that can really dictate pricing for certain things as well.
Good point. Yeah, I mean, I think that it, like you said, it helps to mitigate the risk of fraud, right? The chance of fraud, because of supposedly professionals and analysts and all these things that are vetting them and doing all these. Plus, even to be a publicly traded company, there's an onerous process that's involved with even becoming a publicly traded company, right? So, and then access, right? I think that's another thing. Is like people have. It's really easy to invest, right? It's easy to go and get a Robinhood account. It's very you can start trading with just have a bank account. You can start putting as little as $100. So it's very easy, and the access is easy. Small entry points. You can enter with a lot less money. You need a smaller amount of money to get started. Whereas a lot of the alternative spaces, it comes down to investing more significant amounts of capital.
For sure. Yeah, I mean, that's a big piece of it too. Like the liquidity and access piece is really important too, in terms of looking at like how you go break up your capital to go invest it, right? In terms of how quickly do you need that capital, how quickly do you have to go show liquidity for certain things. And I think a big thing too with looking at is just the data you get behind it as well, right? In terms of the analytics, the by second number evaluation of it. I think that at times, and I'm sure we'll touch on here as well, in the alternative world, you may not have access to go see that second what things are worth, right? Because there are certain costs that go into it. There are certain, market simulations, transactions that are larger. So I think that's a big piece of it too. In the stock market, you can go see your valuations right away as to what your portfolio is actually worth today.
Now, Sam, we covered the pros, right? We covered the advantages of conventional investing. Let's quickly cover the disadvantages of conventional investing. What would you say the biggest or one of the most important disadvantages of traditional investing?
Yeah, I think just the markets in general can be really volatile when looking at the ups and downs of the market itself. Like, for example, you can have a CEO do an interview and things shoot up, things shoot down, right? You can have, small micro, macro events that happen that directly impact the stock price really significantly over a period of time. So I think you have a lot of volatility that some investors don't have an appetite for. I think, people who are looking for more of that consistent flow can find things that fit themselves better than the stock market for events like that.
Mm-hmm. And then plus volatility, it also leads to a perilous situation for financial planning, right? If you're like, hey, look, I know I'm going to need X amount of money when my kids go to college and I need to have a certain amount of money. But hey, if it's an economic downturn where the stock market's down 30%, and you have no way of predicting that, right? Any black swan events or even gray rhinos can derail your financial planning. What else? What are some other disadvantages of traditional investing?
Yeah, I think at times you can see whether it be public companies in a shifting direction as to what they do, right? And making sure that strategy aligns to what you do. There's little to no say in what happens there. I think when you look at kind of finding investment vehicles that really fit the timeline, really fit the risk level, right? Risk tolerance you may have, structure you want. I think there's other opportunities that may fit better. They kind of look at opportunities like that. And then, also looking at tax efficiency too, right? In terms of short-term gains, right? We're looking at kind of higher tax rates around that as well. And then also just looking at, how the kind of macro environment to impact your returns, positively or negatively, I think always has a big impact too.
Yeah, that's great points there. Yeah, I like that. The lower control is a big thing. You're trying to invest in $1 billion company and you own stock. I mean, try talking to the CEO, right? Try giving your input. Whereas, with the alternate investments, you sometimes have access to the general partners, right? So tax inefficiencies, you pay maximum taxes. We as doctors, we already are paying a ton in taxes. And this is one of the most tax inefficient vehicles, period. And your correlation, right? Stocks and bonds move together during major market events, as you said, with national trends, whereas a lot of alternate investments like real estate, we're in inefficient marketplaces where we're not affected as much by national trends. It's a local market, and you can see areas that are growing and areas that are declining, no matter what's happening in the national economy. All right, so now let's get to what we like, right? Like alternative investing, right? Like now we talked about the pros and cons of the traditional investing. Now let's get into alternative investing. Now, when people say alternative investment, what exactly is an alternative? What is alternative investment? What would be considered alternative?
Yeah, I think anything that's outside of traditional asset classes, right? I think you think about stocks or bonds, mutual funds, ETFs, right? Things that if you sit down at a table and talk to someone about them, that most people, or at least a handful of people, won't have clarity on what that looks like, right? Kind of outside of the older generation's idea of investing. where you've got a lot more optionality with where and how you can go place your capital to work for you. Things like real estate, private equity, venture capital, commodities markets, cryptocurrencies, right, hedge funds, you have all different places in which you can go park your capital. Debt, right, that go aligned to where you feel is best in terms of structure, strategy, leadership, etc.
Yeah, so now you just said a whole bunch of things there for alternate investments. Now, my challenge to you is you also mentioned real estate as an alternate investment. How are you coining the phrase that real estate is an alternative and the stock market is convention? Because when I look at it, the stock market started in the 1700s. Real estate's been around since the beginning of human history. So how is that? Why is real estate, or even gold, right? You mentioned commodities. Why is gold considered an alternate? Why is real estate considered an alternate? I think that it's pretty peculiar that we call it that, and now the stock market is now the traditional. That's just a quick side question for you. How is real estate an alternate investment? Why is it not considered a conventional investment?
I mean, I'll take a step back and give a bunch of personal story on this too. So when I first started investing in real estate, right, like I started thinking of how can I start generating passive income? Because my background was sales, it wasn't dentistry, but similar, where if you do well, you'll have some disposable income to go decide how you want to allocate it. And I thought the only way of real estate was buying a single family home, putting a long-term tenant in there, and then managing that property and collecting rent every month, hopefully. And it was the alternative side of it is kind of looking at ways you can go invest actually passively, right? In terms of kind of cutting a check for fractional ownership, right? Similar to a syndication or a fund, where you're buying in for some form of share, right? That investment, like we said, usually a larger check size, usually $50,000 to $100,000 in terms of an investment, but you're kind of owning a share or a fraction of that asset, of those assets in that structure, where you can be truly hands-off. So think alternative just relative to how known it is in the marketplace. If you ask 100 people you meet randomly, you're not gonna get 100 yeses. If you ask 100 people, what do you know about stocks? You at least get something for most people. But I think you just have less people who are aware of the opportunity in this space.
Yeah, and it's also the part that the Wall Street machine has hijacked basic every aspect here, right? Like, so with these alternative aspects, I even look at it as, hey, we're crusaders of Main Street, right? Like we're bringing money back to Main Street and out of the matrix, and we're pulling people out of the matrix one at a time, people here. All right, so now look, you talked about alternate investment, you talked about real estate, you talked about private equity, you talked about venture capital, you talked about hedge funds, you talked about cryptocurrency. I don't know what that means. Okay, so now with real estate, obviously, you talked about direct ownership where you're actually owning it, or you're in syndications or in some type of passively invested in real estate. I get that part. We talk about that on this channel all the time, right? Real estate investments and passive investments in real estate. But private equity, what is that? I've heard of the term. And what does it mean to invest in private equity?
Yeah, so I kind of look at private equity as the Main Street of alternatives, right? Where you can go buy into businesses, right? In similar structures that you may go buy real estate syndications. So you can go buy fractional ownership into a company or companies that are kind of pooled together. You can also go buy ownership in a holding company that owns companies too, right? So I would look at this as a way of, again, in structure, you can be active, you can be passive, right? As an investor, where you're allocating your capital for, again, fractional ownership in a company, parts of companies, parts of a holding company where there's business plan to go out and acquire certain types of companies. Like, for example, we work in this on our end, and right now we're buying paving companies, right? So our goal there in the private equity world is going out and buying 5 or 6 paving companies in one geographical area, right? That you're then, running together to go take and then look to go exit in the future to a larger private equity firm or institution. So we work with investors there as well. I think it's just a great exposure in terms of getting involved in buying businesses, in terms of kind of owning ownership in that. Similar that people can go own ownership in, dentist office, right? Or dentist practice as well, where you can go kind of truck this from any type of vehicle that you want to go choose from.
Yeah. No, that's great. Yeah, it's private equity. I mean, so instead of investing in it's almost like fractional ownership in a business or a company rather than investing in real estate. Would that be a fair way of putting it?
Correct. Yeah. I mean, we've structured ours really similar kind of our end as to how it looks like to go, buy fractional ownership in real estate, to go buy fractional ownership in a portfolio of companies.
Yeah. So now we're actually, I'm glad that you brought up this private equity deal. We are actually partnering with Sam and his group on a private equity deal. We're very excited about this deal. So we're gonna actually, this is great. We're gonna break down this private equity deal a little bit more, just so people can kind of have a better understanding of how a private equity deal works. But before we do that, let's kind of touch on a little bit of the other ones that you mentioned. Venture capital. What's venture capital?
So when I think of venture capital, I think of like investing in startups, right? I came from tech, and I think startups can be great to invest into. I think you have to have a lot of risk tolerance for doing so, right? Like, I view venture capital is that if it's me, I was investing into a fund just for the reason a fund you get exposure over a variety of companies. And the reason I say that is that venture capital, you're far more likely to have a really big return or go to zero, right? Because all these smaller companies that are, coming up and growing, either they'll run out of money, they won't have a marketplace fit, or they'll grow exponentially and be, home run type deals. There's usually very little, from what I've seen, that fall middle of those companies. So you almost look at it in a sense, at least in my eyes, is that if you can get a few companies that do really well, and a lot of companies that don't do so well, you hope that these can outride these and looking at the return profile of them. So I don't have a lot of experience there in my eyes of kind of working in a tech space, but I think that venture capital done the right way probably has the highest upside for returns overall, but in turn, by far the highest risk profile when looking at those options too.
Yeah. No, I would agree with that. So this is venture capital is for somebody that maybe willing to take more risk, has a higher level of risk tolerance, and maybe is a guy that, hey, listen, I want to try to hit a home run. I'm okay with losing the money, but I'm also okay with making a lot of money. So I think that's it's for certain types of appetites, right? Certain people, certain appetites,
or certain parts of your portfolio too, right? Like for example, I think everyone has that 5-10% of their portfolio or net worth that like, hey, we're going to take some swings. Where if we hit on these, there's some real upside. So I would say I think there's places for each of the things we talked about in your portfolio today. But it's also understanding too, kind of where you are in your life, what you prioritize, what tolerance you have, and how much tolerance you have for that, as to how you kind of break out how you choose to allocate which dollars go where, kind of knowing both sides of the coin as to how things can play out with that money too.
Yeah, that's an excellent point. I mean, there is a place even for risk, right, in investments. And again, that can come down to where you are in your career. Are you at the beginning? Are you a beginning wealth builder at the beginning of your career? Are you somebody that has established a lot of wealth in your practice, in your businesses over your career? What are your needs? Is it more income-based? Is it more conservation of wealth? I'm more interested in a conservative approach. Or is it more, hey, I want to keep expanding my wealth. I want a chance to do it. Or maybe I want a little bit of both. I want to have exposure to things like, and then another one we're going to talk about now is things like cryptocurrency. I believe that also falls in a similar bucket as you might put venture capital funds, right? Like for me, I allocate at least 10 to 15% into things that I consider higher risk but higher yield investments. And I would very much I've definitely bought Bitcoin in that bucket. I like Bitcoin, I think, in the long run, but again, I don't have any backing to say it, right? Reason why, I don't know. Nobody really understands what drives the value of Bitcoin, but I have some Bitcoin. But if I were to lose it, I'm not going to cry about it too much because it's not going to sink the ship because it's a small allocation. I believe that, venture capital, this is the type of VC stuff these are the type of things you can be willing to lose if it comes down to it, right? So I think, and there are buckets that, hey, it fits maybe a certain percentage in certain different people's buckets, that percentage will be different. So excellent point there. And then what about hedge funds? I always hear about hedge funds. I always think about Bobby Axelrod on the show Billions. Tell me about hedge funds.
That's one of the shows, in my opinion, of all time. But dude, him and who was their in-house therapist who was awesome, the character.
Yeah,
I forget her name. Yeah, she was awesome.
Reminds me right now. I know exactly what you're talking about.
Yeah, really good show. But
yes.
I think it's the same thing too, where you're investing into, again, a fund, right, into a pool of capital in which that money is being, going out and being used to go trade, right? Trading different derivatives with leverage, options, stocks, right? They're basically, investment firm that goes out and trades your capital, and in turn they take, a portion of the profits and a portion of fees for kind of holding your capital as well. And I think hedge funds, you kind of generalize into like a higher risk type profile, but I think there are hedge funds as well that have, different approaches too. So I say if you're going that route, just finding a group that aligns with what it is that your strategy and your timeline is, right? Because even the same group may have different types of profiles. So for example, like Johnny was saying, if you're someone who is kind of up and coming, you want to go take risks with your capital, knowing you have a nice long working career ahead of you that you want to be committed to, you may be okay being in more of a growth type fund that focuses more on, high upside, where in turn higher risk at times. But if you're someone who is, looking to go deload your work and kind of live off the yield you have, they may have income funds that make more sense for you as well, that obviously have, higher cash flow in the short term and likely lower risk, and therefore likely lower overall returns in total.
Yeah, that's great. That's a great point. And now, kind of the last one, commodities. What do you think about something like gold? What are your gold, oil, right? Agricultural products. I mean, what are your thoughts, opinions about these type of investments? Gold and silver have been around since the beginning of human history, right? They've been traded before Christ, right? So, I mean, what are your thoughts about something like that? Do you invest in gold, oil?
I don't, personally. Not saying it's the right or wrong thing to do. I just haven't put a lot of time into digging around for it. I don't really have a ton for you on that side of it. I think I have, friends who've done well in the oil space too.
Right, Sam, is like, if you look at it as from an inflation standpoint, it's a great hedge against inflation. Like back in 1920, you used to be able to, with an ounce of gold, you could buy a really nice suit. In today's days, an ounce of gold is about $2,500. You can still buy a really nice suit, right? So gold has held its value through time. And if you look now, as the U.S. dollar continues to be debased rapidly, we're seeing Just like the olden days, we're seeing countries starting to hoard gold. We see Saudi Arabia, we see China buying vast amounts of gold for their reserves. So interesting that the pendulum sort of swinging back. And remember, these are things that have been around since people have been around, right? Gold, silver, even oil. Energy tends to do well, when the market's going down, right? Weakening US dollar, etc. And then cryptocurrencies, Bitcoin, we talked about that. So these are some of the alternative investments. Now, what are the pros of an alternate investment? What are the advantages of an alternate investment versus the stock market?
I think with the right strategy and structure, you can definitely outperform the stock market in aggregate, where you have a lot more opportunity. I think in turn, you also have more risk at times as well, depending on the structure itself. So I think like anything, make sure you do your homework in terms of deciding what it is what's best for you. But I'd say if you find the right partners, if you pick the right investment opportunities, if you do your homework the right way, I think you have a lot of opportunity to outperform historical returns in the stock market when looking at those types of returns and structure.
Yeah, so excellent. Yeah, so much chance for much higher returns, and you still have the ability to kind of de-risk deals too, right? With your ability to evaluate them. So I think the risk return that profile is much greater with alternative investments. I agree with you. What else? What are some other advantages?
So I think you can also go kind of spread your capital out among different types of things. Like, for example, on my end, I think I've invested now in 65 different alternative investments in terms of structure, and all different types of things in terms of different asset classes, different types of businesses, different types of markets, different types of hold periods, different types of liquidity, different types of yield versus growth, right? And you kind of spread out your risk into a portfolio. So what I say is you kind of create your own portfolio of your investments that give you that level of diversity that can really help you hedge when the macro environment do things that may be favorable or unfavorable to certain types of investments. You have other areas to go kind of back up in that way as well.
Yeah, that's a great point. What about taxes? We talked about you talked about the traditional investments being very high tax. So what about on the alternative side?
Yeah, so I'd say they can get structured in a few different ways, right? So for example, say you're buying a real estate project and you're holding on to it for a long period of time, right? That return that you have comes in the form of long-term capital gains, which as it states right now is the most effective tax bracket to go be in. Also, you usually see is that you have a level of depreciation, think a phantom paper loss that you receive in that first and second year when you buy an asset or property of some kind, where that can be used to offset cash flow that you're receiving from the ownership of those properties. That helps you kind of reduce that burden throughout the whole period, and longer term becomes a longer term capital gain that's far more tax efficient in structure.
Yeah, I mean, and you kind of touched on a couple of the powerful ones. I found that some of this real estate asset class in general is laden with tax benefits. I would even venture to say this is the most tax advantaged asset class there is, right? I mean, this is the way that the government encourages capital, resources, people to flow into certain areas, and the government can't build housing. Right, so the best way that they can get the private sector to build this housing that people need is by offering tax advantages. So there's some huge tax advantages, and just learning the tax code, learning the tax side of it. We already pay maximum taxes. If you learn a way to save 30 grand, 50 grand, 100 grand in taxes, that's the same thing as increasing. That's the same effect of increasing your net income by that same amount. Right, so just by learning, hey, by my investments, I can pay less taxes. I'm actually increasing my net income. Right, so that's one of the things. And then what about inflation? Now we know that stocks, bonds, they tend to do poorly during inflation, right? What about with alternates? What's the effect with inflation on alternate investments?
Yeah, so ideally they're at least keeping pace in terms of growth with how the dollar is being inflated. So for example, if you look back the last couple of years for just rents, for example, right, they were keeping pace with inflation overall, right? So allowing the asset that you're holding to up in value at the same time with everything else. So it allows you to keep pace there as well. And it gives you tangible assets to hold on to where at times money may be worth less tomorrow than it is today. So it gives you like an actual tangible cash flow type asset.
Yes. Daily.
It's more so how much, more so how much less it will be worth as well. So
that's
definitely gives you.
Part of the biggest contributors to inflation is the cost of housing, right? And so that's like almost intrinsically built in. If inflation's going up, well, real estate values are going up. It's almost like real estate makes inflation makes real estate investors rich. So that's a great strategy, especially I think we're headed for inflationary times. We're lowering interest rates. despite inflation not reaching its 2% target, which tells us that the Feds are willing to accept inflation. And we're bringing interest rates down. This could start stimulating and heating up the economy again. And we're hit with a second wave of inflation. We have an expanding regional war in the Middle East. We have saber rattling in China and Taiwan. We have the Ukraine war continuing. We have multiple wars that we have to continue printing money to feed the war machine and the industrial complex. And where does that money come from? So we can expect inflation not to go anywhere over this next period of time. And I think really focusing on investing in, like you said, tangible assets, we got to look at it because inflation wasn't a factor in America over the last 20 years, right? 30 years. It's been since 1982, and Paul Volcker raised interest rates to 18%. Since then, that set up the next 20 years of economic expansion. So we haven't seen inflation. We've only seen inflation at 2%, but inflation is not going anywhere. And I think that's something we need to be cognizant of because things like these conventional investing tend to be throttled by inflation. So, all right, Sam. So let's kind of start landing the plane here. And then I want to talk about a little bit more about this private equity deal. We don't talk about any private equity, at least not yet on this channel. So I think this is a great example. We can talk about this deal that we've kind of partnered on. But before we do that, let's talk about some of the cons of alternative investment. What are some of the disadvantages? We already talked about illiquidity, right? We don't have money. But what are some of the other ones? Risk.
I think illiquidity.
How would you consider risk compared to a stock market or alternative investment?
So it really depends. I think it's less likely in a scenario in stocks to go to zero, right? I think there are opportunities where both private equity, venture, real estate can go to zero. It shouldn't. I think venture is probably the most likely of all those. I'd say venture, private equity, then real estate in terms of likeliness to go to zero. I think, again, it comes down to investing with the right people where you can go mitigate that risk, understand what levers and assumptions are being made to make an educated decision on where you feel the confidence interval is for yourself and how likely this is to be, incur a loss or incur a significant loss as well. But there definitely is, opportunity where you could lose, some or all of the capital that you invest from looking at deals to invest into for that. So what I'd say is really make sure you're doing your homework on the people, the deal, the structure, the assumptions, or all those things in terms of the investment they're making into a private equity, real estate, venture type deal as well.
Yeah, so I mean, I think that risk part comes with a caveat because from what you're saying is like, hey, look, as long as with these private investments, we have the ability to go and do a deeper due diligence than we can in any other investment, right? So we have the ability to go and find these right operators, right? Get to know these people, get to know people that we trust, and finding people with significant track records, being able to understand, hey, what are the assumptions in this investment? Are they realistic? Right? Those type of things. If you have the ability to do that, you actually have the ability to greatly de-risk these type of deals. You have an ability to really reduce the chances of going to zero. It's not an infallible process, but if you are consistently making informed decisions, intentionally thought out, partnering with the right people, time and time, decision after decision, year after year, I think the overall success rate will be positive. So that's our point on risk. Now you mentioned
something too, like
of traditional investments is regulation, right? Now the counter side of that is, hey, this is a much less regulated area than the traditionals. Why is that? Why is that a con?
Yeah, I mean, I think we've all seen it right in the space of you can have a person just put together a deal and have the ability to go raise private capital from it for investors, like you or myself to go invest into that project. And at times, people are better salesmen than they are operators, right? Or they have assumptions that aren't overly attainable, right? So what I'd say is that it's a space in which you can get started in pretty quickly from the operator standpoint to go put together a project like this for not a massive upfront cost. And in turn, just make sure you're really doing your homework, right? So I think the regulatory bodies there are to protect you, but there's not a ton of regulation in this space as to who can get started and put together projects. So again, like really make sure you're doing your homework. I think working with someone like Johnny as well, who does the homework up front for you, looking at investments is a huge piece of it, right? So all those questions that you're going to want to go ask, I'm sure he already asked on your behalf and has the answers for you as well. So I think working with someone who, one, has their own capital into that project, right? Two, has reasonable assumptions that you feel are attainable. And three, just you really trust that person as well on the human level to execute on your behalf and operate ethically. I think it's really important to look at, do I invest into a project or not?
Yeah, that's excellent insight there. Now, and the last one, you mentioned, hey, it's really simple to invest in the stock market, right? I can just go and open an account. I just have to put a bank account and I can easily start investing. What's the simplicity of this side? It doesn't sound as simple.
So I think it's a few parts, right? One is just getting access to deal flow, where there's two primary types of deals that you'll see in the space that we're in, right? Deals that are a 506B in structure, in which you can only really solicit from people that you have an existing relationship with. So, or they're a 506C in which they can go publicly solicit. We have to be accredited to go qualify to invest into those projects, and then you can get there by net worth or income. So for deals that may not be publicly advertised, I think having the right connections as to understanding who to go to. I think someone like John does a great job as well of getting access to a variety of types of projects for you that he's vetted extensively himself. So I think part of it is the access piece. And then the next part of it is making sure the access you have is good access, right? You don't want to get access to the wrong types of projects, wrong people. So I think one is getting access, and two, start to develop your own criteria as to how you go evaluate. Does this person, does this project, does this opportunity make sense for me, my risk tolerance, my goals, and it's the best place to currently park my capital? Just because I think a big thing here, again, is the illiquidity is a big thing, right? Where there are not secondary markets for these types of products, really. I've seen it at times, but I'd say something that's much more the exception versus the rule. So again, all things to consider when making investments in something like this, but there are a lot of ways that you can go mitigate risk in doing so. I think a big first thing too is just getting access to these types of deals and putting together your own plan as to how to go review them. I'm sure someone like Johnny can go help you as to what things to look for and what things are things that you should definitely run from as well.
Yeah, that's great. That's great. All right. So now let's get into the final round here. Now we want to talk about this private equity deal. I think this is a great example. This is a deal that Sam and we partnered with Sam on this deal. This is actually a live deal right now currently. So if you are interested, after we're going to talk about this deal just so that you can kind of learn it from an educational standpoint, how private equity deal works. But then if you are interested, our fund is open. We are accepting on this deal. You can check that in the link below for our website, and you can find access to our portal there. But Sam, let's talk about private equity, man. I'm really excited about this deal that you guys are putting together here. It's called the PAVE, and let's dive into that a little bit. Now, private equity, as we mentioned, this is investing in private businesses, right? Businesses that haven't gone public. They're not in the stock exchange. You can't buy them in any stock exchange, but they're private companies that are looking for capital for growth of their company. So now let's go into a little bit about the opportunity that you currently are working on. Well, I should say we.
Yeah. So So right now, I mean, the last year we spent doing a ton of research on everything from tech companies to service businesses, and we landed on paving. And the reason we landed on that, versus the more mainstream like HVACs or right, where we saw that paving we felt was very undervalued. We also saw that there was a really big market opportunity. So, for example, in the real estate world, you're seeing an apartment complex trade for a multiple money between 14 to 25x what the net operating income is over a 1 year period. In the paving space, most companies we're targeting trade between 3 and 5x EBITDA, where what we've seen is that companies that are in that $1 to $3 or $5 million EBITDA range, there's a very small pool of buyers who can go take those companies down and go actually integrate them the right way. Right? They're too big for the mom and pop who wants to just go buy a service company and manage it. They're also too small for the institutional type buyer that wants to go and has to deploy checks of 30, 40, $50 million at one time. So on our end, we felt as though we can go buy companies, paving companies that have more of the traditional baby boomer type owner that has been there for decades of grinding through the work in terms of building out a business that can go perform at $1 million, $2 million a year for them personally, but they're ready to go take that money and retire, right, and go move on and do something else. And there's an opportunity to go help them transition out of that business, buying it at a really fair valuation between 3 and 5x EBITDA. And what we've seen is that there's opportunity to go create a level of synergy for these companies. So for example, think things like bringing marketing and legal and accounting in-house to go save dollars, or think of things as kind of creating a sales motion for these companies versus only using word of mouth, be able to go bid on larger jobs. And in turn, we see opportunity to go make these companies operate more efficiently and get in front of the right people more frequently. But when you look at building a portfolio of companies in a geographic area that they're trading, if on our end, if we can get to about that 10 million or so EBITDA mark across the portfolio itself, that valuation goes from 3 to 5x to more 8 to 12x in terms of the multiple that you'll get. So for us, we feel as though there's a large premium that these larger corporations, institutions, private equity firms will pay a group like ours to go in and aggregate, right? Go do that legwork of finding and negotiating companies, right? Integrating systems and operations, right? Marketing, legal, accounting, and they'll pay us a big premium in terms of valuation. Go do that work for them so they can go deploy that bigger check. So for us, we feel as though it's a very low risk profile versus the upside in terms of return profile that we feel like we can reasonably achieve.
Yeah, it's an amazing business plan, guys. Again, if you want to learn more about it, go to our website, walkofwealth.com, It's in the description below. Within that website, you're going to see the link to the fund. The deal is there. It's a fantastic opportunity. Really high upside. I really like the group of people around. So now we're talking about all of these factors in this video. It's, hey, look, developing trust, partnering with the right team, right group of people. These are probably the two most important things when you're looking at a private equity deal. And again, the advantage of private equity over a real estate deal is that the return profile is much, much more favorable than a real estate deal. The risk is perceptibly, it's considered a higher risk investment because now you're investing in businesses. Whereas real estate is, it's something on the ground, it's something people are living in. So It's considered a lower risk investment. But the trade-off is more high return. We also mentioned that with private equity deals and any alternate investment, you can greatly de-risk the deal or mitigate the amount of risk by finding the right team of partners, right? Finding experts that have the ability to go in and evaluate these business plans and say, hey, look, yes, this is a realistic type of expectation, or no, that these guys are out to lunch. These guys, there's no chance for this to happen. Assembling that team around you can also help guide you when you're making these decisions in these type of private equity companies. Is there anything else that you want to add, Sam, before we start landing the plane here?
Yeah, I think one of the last things I'd leave you with is that when you look at, there's two things. So one, when you look at the businesses that we're buying, they've been around for 15, 20, 30 years, right? Where they have a repeated track record of being profitable, right? They're things that AI can't go take over. They are things that the government is putting meaningful spending behind, looking at the bipartisan act, right, to go fix our C or C- grade roads across the United States.
Trillions. I believe it was trillions of dollars into the infrastructure project, right? Into infrastructure plans.
It's about 110 billion just on roads alone.
Wow.
So we see a huge opportunity to go take a piece of that business and go take companies that are profitable already today. And our goal isn't to go double, triple their revenue, right? If we can go have incremental gains and efficiency gains, we get the whole way there in terms of our business plan. And what I'd say, secondly, is that when you look at real estate, for example, say you're buying a multifamily apartment complex, there's only so many levers you can go pull to go increase the valuation of that property. You can go add a washer dryer, you can go renovate the units, add new signage, create some new amenities. But what you're really capped on is what will that market itself absorb in terms of a maximum rent payment, right? Because if your unit next door is at $1,000 a month and you make yours way, way, way better, but the market itself can only afford $1,000 a month, you may have more occupancy than the person next to you, but they can only pay so much to be in that certain area. So I think what we're seeing is that it's also perceived more risky because there are more levers that can be pulled. So for us, we view that as opportunity and ways to go really create operational efficiencies that drive both top and bottom line revenue to the company itself. So we're super excited about it. I think today's check, I personally put into a deal myself in the last while too. So I think we're, feel really good about it. And we feel really confident in the strategy and the pipeline we have. We have, acquired our first company in the last few weeks. We have 2 more under contract as this past week as well. That can get us towards that about $7 million EBITDA mark towards the end of the year, early next year. So we look, we're pacing very well to get into that threshold where that institutional buyer starts having interest in kind of who it is looking to go buy the portfolio in the future.
Well, that's awesome. I know that you closed on one, and now you're saying there's 2 more under contract. That's really exciting. So yeah, now let's so now the last thing I want to ask you, and I kind of ask our guests, is like we're going to switch gears a little bit and ask you to what's the book that you've shared most in the last year? Let me not say book. What's the most impactful book, audiobook, podcast, webinar, any educational series? What would you say has been the most impactful for you over the last 12 months?
So I think on the podcast side, I think All In's awesome when looking at All In.
All In.
You've got 4 very wealthy business people who talk about what's going on in the world. I think that's really cool for just both macro and micro type economics, life, right? Being able to go relate things through. I think that they do a great job of it. I think for books I recommend a ton. The Psychology of Money is great. Persuasion is awesome. I think it depends on kind of what you want to go do. But yeah, those 2 I recommend a ton to people that I know.
Nice, man. I like that. All In podcast. I'm definitely going to look that one up. Persuasion. That's Robert Cialdini, I believe, the godfather of influence. That's a classic. Psychology of Money. Any apps? Any productivity apps? Websites? Anything like that? It could be personal. It doesn't have to be business. Like any podcast or apps that you've found that have been helpful, or technology or websites.
I mean, for me, probably my most used site out there is LinkedIn. Like I'm a huge LinkedIn believer. I think it's great in terms of getting access, especially if you are kind of making that pivot in the field. So for example, if you are, you own a dental practice, right? You may have not had to have a LinkedIn profile in terms of your branding and your work to attract clients. I think for kind of breaking into the space now of kind of taking control of your financial destiny. It's great to get exposure, a lot of educational content on there, a lot of nonsense on there as well, always, when you kind of enter social media. But I think if you kind of can sift through the stuff on there, there's definitely some interesting things to go see and great ways to connect.
All right, cool. Very good. All right, Sam. I want to thank you again. It's a pleasure every time I see you. I think I saw you in the Lone Star Capital Summit in New York City a few weeks ago. Always pleasure talking to you. Always full of great advice, insights. If the listeners want to learn more about you or what you're doing, what's the best way to learn more about you and find out about what you're up to?
So I'm super active on LinkedIn. Just Sam Silverman. Love to see me pop up. I'd say best place to contact me is there. I'm super responsive. But yeah, LinkedIn, silvermancapital.co is our investment arm. But yeah, either place, super active on either one of those.
Very good. All right. Thanks again for being here. And to quote the great and late Jerry Springer, until next episode, take care of yourself and each other. I'm Dr. Johnny Walker.